Hello, I'm Vadani Arya. This is lecture 10 of my online course, Writing a Business Plan for Your Business. Financial forecast for your business. Your financial forecast interpret what you mention about your business into figures. Set out past financial information for the last 3 to 5 years, if available. Break total sales figures down into parts. For example, sales of different types of products or to other groups of customers. Show the gross margin for each sales element. List what cost include as direct cost of each component. Show the movement in the essential working capital items of stock, trade debtors, and creditors. Use ratios such as stock turnover in months, debtors time in days, and creditors period in days. Emphasize any significant capital expenditure made. Make an up-to-date balance sheet and a profit and loss account. Explain the reasons for profitability, working capital, and cash flow movements. Match them with business actuals. Prepare financial forecasts for the following 3 or even 5 years. The cleverness of your forecast should reflect the sophistication of your business. Small businesses may only need sales, profit, and cash flow budgets. A more complicated asset-based business with complex working capital requirements also needs balance sheet. Balance sheet forecast. Use the same format for the past data to make checking possible. Clearly state the assumptions behind the predictions. These should tie in with what you say in the rest of the plan. For instance, profit margins should probably fall if the program displays the market is becoming more competitive. Be realistic about forecast in new markets. For example, how many resources can you assign to selling? What sensation rate can you assume? And what time will it take to convince new customers? Look at the overall trends of past and forecast numbers. Are they believable? Do the forecast allow for problems and payment delays affecting cash flow? Judge what if circumstances. For instance, imagine the consequence of your cash flow situation if the sales are 20% lower than the prediction or 15% higher. Add detailed financial forecast in an appendix at the end. Include a detailed list of assumptions, especially if you are a startup. For instance, the profit margin on each creation, the time it takes to collect payments from debtors, what credit suppliers will offer you, what financing do you expect, and what interest rate will pay you. Use the cash flow predictions for any financing needs. Add an extra emergency amount onto the funding needs. Giving in the forecast may be 10 to 20%. Consider what mid-month heights could be. What are the dates here? Heights are high. Find what is the type of funding you will require. For instance, long-term loans or an increased overdraft amount. At the likely interest or dividend cost of any new finance. Conduct sensitivity test on the cash required by changing key factors such as sales or margin. Note the results. Explain why the financing is required and what you can use it for. If necessary, get help. Small business advisors at banks and business support organizations may help you prepare financial forecasts free of charge. SWOT analysis. The SWOT analysis helps show you understand your business and the critical external factors you must deal with. Make a one-page analysis of strengths, weaknesses, opportunities, and threats. Strengths might show brand name, quality of creations, or management experience. Weaknesses might be less capital and dependence on few customers. Opportunities might be increasing pressure or an opponent going broke. Threats might be a downturn in the economy or a new opportunity. Be straightforward about your limitations and the threats you face. Spell out modifying situations and the defensive actions you are taking. I hope you like this video and able to write the financial forecast for your business. Thank you very much for watching the video. Thank you. Bye for now.